Well, there's no reason to believe that things in Ukraine are going to get any better.
If you turn on CNBC, you'll probably hear something like
this, I think, is
this.
just a further indicator that the market doesn't know which direction to move on this. And I wouldn't be selling at a time when the VIX is at 30.
With sentiment index, the VIX.
Just remember, in the peak of the pandemic, we hit, over 80 on the VIX. There's a
The
lot
volatility index, also known as the VIX, or even Wall Street's fear gauge.
It's always been called the fear index.
It basically takes a read of the market's blood pressure. The VIX goes higher when investors are scared, anxious, nervous, and uncertain.
What is the risk? What's the fear? What's the level of uncertainty or even the level of stress that's in the marketplace at a given time? It's just a unique tool that we can actually quantify that.
So, even though volatility seems intangible, there's actually a way that markets measure such turbulence and sentiment. I mean, take a look at this equation.
What does it mean for the market when Russia invades Ukraine, right? So you can see that in the VIX, and you can see that in real time in the VIX.
And investors rely on it.
When you understand how investors are feeling about what's going on in the world, you can then understand how the market may move.
Here's how market volatility is measured and how investors use that information to make money. Stock price changes are simply the product of people buying and selling stocks.
So volatility is just price movements that are above normal variance.
The reason that the VIX index was created was it was a way to measure what institutional investors or the big investors were doing to hedge their bets. And if they were hedging that the market was going to go down, that was a sign that there was fear in the marketplace.
When the VIX was originally introduced in 1993 by the Chicago Board Options Exchange, it had a different methodology based on calculations around the S&P 100. And that old measure still goes by the ticker symbol VXO. But since 2003, the CBOE updated the VIX to be based on the S&P 500.
Because the S&P 500 is this measure of the broad market, the VIX is a measure of the volatility of the broad US stock market.
So usually there is an inverse relationship between the activity that's happening in the major index, which is the S&P 500, and what's going on in the VIX. So it's generally inverse.
The VIX is a forward-looking index measuring implied volatility. As the CBOE puts it, the VIX index is intended to provide an instantaneous measure of how much the market expects the S&P 500 index will fluctuate within 30 days and measures to what degree investors are uncertain about the stock market.
The movements are really triggered by major events. If it's negative news, then sometimes people get a little bit scared. That's why when we talk about the VIX, we call it the fear index, or people tend to really kind of want to move and transition their assets out of more riskier assets and into more safe assets.
If you look at the VIX over the past few years, you can see it spike when the pandemic hit in March 2020, which was a record, and then again in October 2020 when infections spiked and stimulus negotiations stalled, or in November 2021 when Omicron swept the nation. Then even more recently when Russia invaded Ukraine in February 2022.
Overall uncertainty also spikes the VIX. So when we see the VIX spiking and getting higher in January and leading in really the beginning of February, that was primarily around this uncertainty of the Fed and when they were going to raise rates by how much, the pace, all of that kind of stuff.
There's a complex mathematical equation at the core. Basically, the VIX measures volatility by tracking trading in S&P 500 options.
It's measuring implied volatility over the next 30 days, and that's derived from option activity. So puts and call options are deriving whether the VIX is above norm or below. And that's the catalyst for what sparks and moves it in either direction.
Now, the options market makes this a little tricky.
Options are just a hedge. You don't own the stock outright, but you're owning the option that's tethered to the stock.
Let's say something happens in the world, an event happens like the Fed's uncertainty or Russia invading the Ukraine, and investors believe that the overall economy is not going to be more positive in 30 days. The options contracts that they're buying, it's really betting on the market going down.
Obviously, it can get far more complicated from here, but just on a very basic fundamental level, it's a hedging opportunity.
What options contracts allow us to do is bet on whether a price is going to go up or a price is going to go down.
This is what the VIX index follows to gauge market volatility, those trades. Imagine a roller coaster. When stocks sell off, investors may get scared, so they could buy options to protect their investments. All those protective purchases, aka options, send the VIX higher.
It's really measuring the degree of price movements. So like the larger the price movements, the higher the volatility. And just to kind of put some things in perspective, VIX readings over 30 are considered, relatively large volatility.
VIX below 20 is an indication that the market is rather complacent. So there's not a whole lot of concern for any near-term volatility and or events that would spark a drawdown.
When the VIX is popping, so it's soaring, it's above 19, which is its median, its average, it is mean reverting. So when it moves up very quickly, it comes back down to its center, that 19, or its moving average. Oftentimes you can look at the 20-day or the 50-day moving average. When it gets very far away from those technical levels, you can expect it to fall back down into that territory relatively quickly.
Oftentimes, investors are always looking at the VIX today as, hey, 30 days from now, we're going to be extremely volatile, and that might not be the case. They're taking input data from today, buying activity, premium, options for today that's implying the future for tomorrow, but tomorrow could be a very different day. And I think that's very important to make sure you take note of as a retail investor.
Investors can use the VIX to help them make investment decisions, or they can indirectly invest in it.